If you enjoyed this audiobook, please consider liking, sharing, and subscribing to the channel. Sharing it with your friends and family helps spread knowledge, and when we help others grow, we grow too. Thank you so much for listening. Let's dive into the book. Chapter 1, Seeds of Uncertainty. Part 1, The Coin Toss. Luck, Skill, and the Market. The coin toss, luck, skill, and the market. Imagine flipping a coin 10 times. If it lands on heads 7 times, you might think you have a special talent. In investing, a few successful trades can feel the same way. Markets often reward or punish us in ways that blur the line between skill and pure chance. Understanding this difference is critical. This section explores why even experts misjudge their abilities, how randomness shapes outcomes, and why humility protects your portfolio. You'll learn to spot when luck is masquerading as skill, and how to make decisions that stand the test of time. Consider Rohan, a tech worker who invested in cryptocurrency during its boom. After tripling his money in 6 months, he quit his job to trade full-time. "I've cracked the code," he told friends, but when prices crashed, he lost everything. Rohan's early wins were likely luck, a hot market lifting all boats. Not genius. His story mirrors hedge fund long-term capital management. In the 1990s, Nobel Prize-winning economists used complex models to reap huge profits, believing their skill guaranteed success. When unexpected market shifts hit, they collapsed, threatening the global economy. Both cases show a universal truth: success can blind us to randomness. How do we avoid this trap? Start by asking, if this investment failed, would I still trust my process? Skill shows up consistently. Luck fades. Think of investing like weather forecasting. A meteorologist uses data, skill, but admits uncertainty, carrying an umbrella even if rain isn't guaranteed. Similarly, great investors build portfolios for multiple futures, not just one optimistic outcome. Take Lena, a bakery owner who invests in stocks. She allocates only 5% of her portfolio to high-risk ventures, diversifying the rest into stable index funds. When one risky stock soars, she doesn't celebrate prematurely. She knows a single win might be chance. Lena tracks her decisions in a journal, reviewing them quarterly. Was a loss due to poor research or bad timing? Was a win based on solid analysis or market hype? This habit separates controllable actions from uncontrollable results. Probability teaches that randomness clusters. Roll a die enough times, and you'll see surprising streaks, like 3 sixes in a row. Markets behave similarly. A decade-long bull run might make average investors look like prodigies. But when conditions shift, those without rigorous methods suffer most. What's one investment decision you credit to skill, and how might luck have played a role? Humility is the investor's armor. Benjamin Graham, the father of value investing, stressed that no one predicts markets perfectly. His disciple Warren Buffett succeeds by admitting his limits, avoiding tech stocks for years because he didn't understand them. This mindset prevents overconfidence. It also encourages continuous learning. When Elena, a retired teacher, lost money on a real estate bet, she didn't blame bad luck. She studied economic cycles, realizing she'd ignored warning signs. Her next investment included a buffer against downturns. Unpredictability isn't a flaw, it's inherent to markets. Embracing it means focusing on process. Research thoroughly, diversify widely, and define clear rules for buying, selling. Then when randomness strikes, a sudden crash or windfall, you won't confuse noise with skill. This balance prepares us for rare earth-shaking events that defy all predictions. Part 2, Black Swans, when the unthinkable happens. Imagine a sudden storm hitting on a clear day. That's a black swan event. Something so rare and unexpected, it reshapes everything. In 1998, a hedge fund called Long-Term Capital Management collapsed almost overnight. Run by finance experts and Nobel winners, they used complex models predicting market behavior. But when Russia unexpectedly defaulted on its debt, global markets spiraled. Their models hadn't considered this possibility. Investors lost billions. This shows how even the smartest plans fail when the unthinkable strikes. How might your own investments hold up if something unimaginable happened tomorrow? Black swans get their name from the old belief that all swans were white, until black ones were found in Australia. These events share 3 traits. They're extremely rare, their impact is massive, and afterward, people claim they were predictable. Think of the 2008 financial crisis, COVID-19, or sudden wars. Traditional risk models rely on past data, but black swans haven't happened before. Like designing a ship for calm seas only, it sinks in the first real storm. Consider Leo, a restaurant owner who invested heavily in tourism stocks. When a volcano erupted in 2010, ash clouds grounded flights for weeks. His stocks plummeted. Leo learned that diversification across similar industries offered no protection. True resilience meant spreading risk across unrelated assets, some stocks, but also bonds, commodities like gold and cash. During the 2020 pandemic, gold surged while stocks crashed. This balance acts as shock absorbers. What single event could unravel your current strategy? Flexibility matters too. Rita, a freelance designer, kept 6 months' expenses in cash. When AI tools disrupted her industry, she used that buffer to retrain without selling investments at a loss. Contrast this with long-term capital management. They borrowed heavily to amplify bets. When markets moved against them, debt magnified losses. Avoiding borrowed money creates room to adapt. As one investor put it, surviving black swans isn't about predicting storms, it's about building a boat that won't capsize. Psychological traps worsen our vulnerability. We assume tomorrow will resemble yesterday. Before 2001, few considered terrorist attacks could paralyze markets. Afterward, it seemed obvious. This hindsight bias tricks us into feeling safer than we are. Another pitfall: overconfidence in technology. In 2010, the flash crash saw stocks nosedive in minutes due to automated trading glitches. Systems designed to reduce risk instead created chaos. Have you ever felt too confident in a foolproof plan? Preparation starts with humility. Admit you can't foresee everything. Allocate a portion of your portfolio to assets that thrive in chaos, like treasury bonds or essential commodities. Regularly stress test your investments. What if inflation triples overnight? Or what if my job disappears? Such exercises reveal hidden fragilities. The goal isn't to avoid risk, it's to ensure no single disaster sinks you. This mindset shifts focus from predicting the future to surviving it. History teaches that recovery matters more than perfect foresight. After the 1929 crash, investors who held diversified low-debt portfolios regained losses years faster than those chasing hot stocks. Modern tools like index funds spread risk across hundreds of companies cheaply. When airlines crashed during COVID, tech stocks soared. Capturing that shift required broad exposure. Building such resilience sets the stage for our next idea: creating buffers so even severe blows don't break your finances. Part 3. The margin of safety. Building a cushion. After the turbulence of unexpected events, resilience comes from preparation. But how do you create that buffer? Imagine buying a sturdy umbrella, not when the sun shines, but at half price during a drought. That discount is your shield against storms. This section explores how smart investors protect themselves by paying less than an asset's true worth, creating room for error when life or markets surprise us. You'll learn practical ways to build this cushion, sleep better during volatility, and turn uncertainty into opportunity. Consider Ravi, who bought shares in a shipping company at $50 each because analysts predicted growth. When a trade dispute erupted unexpectedly, stock prices plunged to $30. Ravi panicked and sold at a loss. Now meet Elena. She calculated the company's real value, factories, contracts, cash reserves, at $65 per share. She waited for a market dip and bought at $40. When the same dispute hit, her cushion absorbed the shock. She held calmly, knowing she'd bought wisely. Years later, the stock recovered to $70. What separates their outcomes? Elena's approach gave her options Ravi never had. This principle isn't about complex math. Think of it like haggling for a used car. If you believe it's worth $10,000 but pay $7,500, you've built-in protection for hidden engine trouble. Similarly, buying a rental property below neighborhood prices guards against vacancies or repairs. How often do you leave yourself that wiggle room? During the 2008 financial crisis, investors who'd purchased stable companies at discounts weathered the chaos better than those chasing trendy stocks. One bakery chain, for instance, traded below the value of its ovens and store leases. Savvy buyers recognized this gap. When the economy rebounded, they gained not just from recovery, but from that initial discount. Building this buffer starts with 3 steps. First, estimate an asset's fundamental value. For stocks, examine earnings over 5 to 10 years, not just recent spikes. For real estate, compare prices per square foot to similar buildings. Second, wait for market pessimism. Fear sells good assets cheaply, like when headlines scream about industry declines. Third, insist on a gap. If your calculation shows a stock is worth $100, buy at $70 or less. That $30 buffer is your insurance against bad forecasts or bad luck. Psychologically, this transforms investing. Volatility feels less threatening when you know your downside is limited. You'll avoid desperate moves, like selling low during a panic. Instead of watching daily price swings, you focus on long-term value, a mindset that compounds gains. This concept naturally leads us to a humbling truth. We can't predict everything, but by planning for unknowns, we make them less dangerous. What invisible risks might your current investments carry? And where could a safety net change your next decision? Part 4. The Power of Not Knowing. Embracing Uncertainty. Imagine standing at the edge of a forest you've never entered. You can't see every root or animal hidden in the shadows, but you know walking in could reveal new paths. Investing mirrors this. Instead of fearing what you don't know, see it as space for discovery. This part explores how admitting uncertainty protects you from costly errors and sparks smarter strategies. You'll learn why the most successful investors stay curious, not certain, and how this mindset builds resilience. Let's see how embracing the unknown transforms risk into opportunity. Many investors crave certainty like a compass in a storm. They cling to predictions, assuming tomorrow will mirror yesterday. Take Ben, a tech entrepreneur. After selling his startup, he poured money into cryptocurrency, convinced it would double in months. He ignored market signals and dismissed friends' cautions. When regulations shifted unexpectedly, his portfolio lost 60%. Ben's story shows how overconfidence blinds us to what we can't control. What belief about your own investments might need questioning? The wisest investors treat markets like shifting weather. They carry an umbrella even when skies seem clear. Consider Priya, a nurse who started investing during the pandemic. She knew she couldn't predict viral variants or supply chain shocks, so she diversified across healthcare stocks, renewable energy, and bonds. When travel stocks plummeted during a new variant surge, her renewable holdings balanced the loss. Priya's approach reflects a key truth. Acknowledging uncertainty forces you to prepare, not predict. History warns us against false certainty. In the 1990s, hedge fund long-term capital management used complex models assuming markets would behave normally. When Russia defaulted on debt, an event their equations deemed near impossible, the fund collapsed, threatening global markets. Their mistake? Treating uncertainty as a math problem to solve rather than a reality to respect, like assuming you know every turn in a maze before entering. Practical steps help turn uncertainty into strength. First, build what-if scenarios. Ask, if this industry faces new regulations, how would my investments fare? Second, leave room for error. If you think a stock is worth $50, buy at $35. That gap is your buffer against surprises. Third, study history. Market crashes, innovations, and geopolitical shifts have happened before. Patterns teach, but don't guarantee. When did you last change your mind because new information challenged your assumptions? Embracing the unknown cultivates adaptability. Carlos, a retired teacher, once panicked during every market dip. After learning about unpredictable black swan events, he shifted. He now keeps cash reserves and rebalances quarterly. Last year, when inflation surged unexpectedly, he avoided selling in a panic. His calm came from expecting surprises, not fighting them. This mindset turns volatility from a threat into a teacher. How might your decisions improve if you accepted some questions have no answers? Ultimately, uncertainty isn't a wall, but a doorway. Investors who walk through it stay humble, ask better questions, and adjust faster. They know tomorrow could rewrite every rule. This acceptance doesn't paralyze, it empowers. Like a sailor who checks the forecast but still brings a life jacket, they navigate wisely precisely because they respect the unknown. In our next exploration, we'll see how luck and skill dance in every investment outcome, blurring lines we often pretend are clear. Chapter 2, The Human Factor. Part 1, Fear and Greed, the Twin Engines. Fear and greed, the twin engines. Imagine standing on a crowded trading floor during a market frenzy. Sweaty palms grip phones, voices rise to shouts, and screens flash red or green. This chaos isn't driven by spreadsheets. It's fueled by two primal emotions, fear and greed. These forces twist rational thinking, turning calculated investors into panicked herds or overeager gamblers. Throughout history, they've inflated bubbles and deepened crashes. By learning to spot their influence in your own decisions, you'll gain a shield against costly mistakes. This section reveals how these emotions hijack judgment and shares battle-tested ways to stay grounded when others lose their heads. Consider Leo, a bakery owner who invested in tech stocks during the late 1990s dot-com boom. As prices soared daily, greed whispered, "Skip the research, everyone's getting rich." He poured savings into flashy startups with no profits. When the bubble burst in 2000, his portfolio dropped 70%. Fear then took over. Convinced stocks would keep falling, Leo sold everything, locking in losses just before markets rebounded. His story mirrors millions. Greed blinds us to risk, fear blinds us to opportunity. How often have you chased hot tips or sold investments after bad news? Market cycles follow predictable emotional patterns. During booms, greed breeds overconfidence. Investors ignore warnings, assuming this time is different. In 2008, banks bundled risky mortgages into complex products. Greedy buyers ignored the ticking bomb, lured by high returns. When housing collapsed, fear spread like a virus. Even solid companies were dumped at fire sale prices. Psychologists call this loss aversion. The pain of losing $100 hurts twice as much as the joy of gaining $100. This imbalance explains why panic selling often hits hardest at market bottoms. Managing these impulses starts with self-awareness. Ask, am I buying this because it's truly valuable or because others are? Create simple rules before emotions flare. One strategy, set sleep test price limits. Decide in advance, if stock X falls 20%, I'll reassess fundamentals, not headlines. Another tool is dollar cost averaging. By investing fixed amounts monthly, you avoid greedy all-in bets or fearful retreats. Benjamin Graham's margin of safety principle also helps. Only buy assets so cheap that even if you're wrong, losses stay small. Real-world discipline looks like Priya, a nurse who invested during the 2020 crash. While colleagues sold stocks in terror, she stuck to her plan, monthly index fund purchases. Why? She'd prepared mentally. "I knew downturns are normal," she said. "My strategy didn't need genius, just consistency." 2 years later, her patience paid off. Contrast this with Ken, who chased crypto hype in 2021. When prices crashed, fear paralyzed him. He forgot his exit strategy and watched gains vanish. Preparation beats willpower. Build an emotional circuit breaker. Keep 5% of your portfolio in cash or stable assets. This buffer reduces panic when markets tumble. Nassim Taleb's barbell strategy takes it further. Put 85% in ultra-safe investments, like treasury bonds, and 15% in high-risk opportunities. You avoid catastrophic losses while leaving room for growth. And when greed tempts you, review historical bubbles. Dutch tulip mania saw bulbs traded for mansions before becoming worthless. Ask, does this opportunity rely on endless optimism? These emotions never vanish, but their power fades with practice. Treat investing like a cross-country drive. Greed shouts, "Speed up! We're missing views." Fear mutters, "Pull over, storms ahead." Wisdom lies in steady pace. Check your map goals, watch your fuel, risk tolerance, and ignore backseat drivers, market noise. Next, we'll explore how hidden biases shape the stories we tell ourselves about money and why questioning them builds unshakable confidence. Part 2. Stories we tell ourselves. Bias in investing. Our minds are storytellers. They weave narratives to make sense of complex financial decisions, often filling gaps with assumptions and emotions. These internal tales shape how we interpret market movements, company performance, and personal risk tolerance. Left unchecked, they become traps, distorting reality and leading to costly mistakes. This section reveals how common mental shortcuts sabotage investment outcomes. You'll discover practical methods to spot these hidden influences in your thinking patterns. Through relatable stories and straightforward solutions, you'll gain tools to separate facts from fiction in your decision-making process. Imagine Priya researching a solar energy stock. She reads 3 positive reports and feels convinced. When she later finds an analysis warning about regulatory risks, she skims it and thinks, "This analyst doesn't understand green energy." This is confirmation bias, seeking information that supports existing beliefs while ignoring contradictory evidence. Months later, new regulations hit the industry hard. Priya's portfolio suffers because she filtered out critical signals. When did you last dismiss information that challenged your investment thesis? Hindsight bias rewrites history. After a market correction, Ben tells friends, "I saw the downturn coming months ago." Yet records show he increased his stock exposure weeks before the drop. Our brains trick us into believing past events were predictable, fostering false confidence in future predictions. This distortion causes investors to underestimate real uncertainty. Overconfidence amplifies risk. Take Carlos, who turned $5,000 into $7,000 with quick crypto trades. He now believes he's beaten the system, leveraging his portfolio to chase bigger wins. When volatility strikes, he loses 60% in weeks. Studies show most active traders underperform the market long-term, yet 82% rate their skills as above average. This gap between perception and reality stems from misinterpreting luck as skill. What percentage of your past wins resulted from strategy versus circumstance? The 1998 long-term capital management collapse illustrates bias in experts. Nobel-winning economists used complex models assuming historical patterns would repeat. When unexpected global events unfolded, their overconfidence in predictability and refusal to acknowledge new risks caused a $4.6 billion meltdown requiring Federal Reserve intervention. Combating biases starts with simple habits. Keep an investment journal. Record reasons for each decision, expected outcomes, and potential pitfalls. Review entries quarterly to spot patterns. Actively seek opposing viewpoints. For every buy analysis, find one sell argument. Implement automatic rules. Set allocation limits, e.g. no single stock percent of portfolio and trading frequency caps. Diversification remains your most reliable bias breaker. Spreading assets across uncorrelated classes, stocks, bonds, real estate, reduces emotional attachment to single outcomes. Recognizing these mental shortcuts transforms investing from reactive storytelling to proactive strategy. You'll notice when emotions color interpretations, replacing assumptions with evidence-based choices. This self-awareness builds resilience against market noise and prepares you for a crucial truth. Investments carrying personal consequences inspire sharper judgment. Part 3. Skin in the game. Why stakes matter. Imagine making decisions where your own money isn't on the line. How carefully would you choose? This section explores why personal investment changes everything. When real stakes exist, people tend to think twice, research thoroughly, and act responsibly. We'll see how restaurant owners who eat their own cooking make better chefs, and why surgeons who refuse unnecessary procedures on their families gain trust. Through everyday situations and financial cases, you'll discover how skin in the game creates natural accountability. Learn to spot when others lack real stakes in your investments, and how to structure choices so consequences align with intentions. Consider Rohan, who invested 5 lakhs in his cousin's startup. He barely reviewed the business plan, assuming family ties guaranteed success. When the venture struggled, he felt disappointed but unaffected. This was fun money set aside for speculation. Contrast this with his 50 lakh retirement fund. For this, he researched fund managers, asked how much of their own wealth was invested alongside clients, and chose one whose personal savings mirrored his strategy. This difference matters profoundly. Fund manager Alina requires her team to invest 20% of their bonuses into client portfolios. During market turbulence last year, while competitors panicked, Alina's group methodically reviewed holdings. Why? Their personal losses would mirror their clients'. One analyst even halted a risky trade, admitting, "I wouldn't risk my daughter's education fund on this." When have you noticed someone's choices improve because they shared the downside? History offers stark lessons. In the 1998 LTCM collapse, Nobel-winning economists used complex models to bet billions, mostly with borrowed money. Their personal stakes were minimal compared to the fund's size. When markets moved against them, they doubled down, believing their intellect could override reality. Result? Near total implosion. Had they risked family assets proportionally, would they have leveraged so recklessly? Practical alignment starts with self-assessment. Before any investment, ask, if I lost 100% of this amount, what would change? If the answer is nothing vital, your stake may be too small to inspire due diligence. Next, evaluate advisors. Ask directly, What percentage of your net worth is invested identically to mine? Favor those charging performance-based fees over flat rates. They profit only when you do. A local bakery owner, Priya, demonstrates this daily. She tests every new recipe on her family before selling it. When a supplier offered cheaper but lower quality vanilla, she refused, knowing her children would taste the difference. Similarly, when investing in stocks, she never buys companies whose products she wouldn't use herself. How might your consumption habits inform smarter investment screens? Finally, structure decisions so consequences flow both ways. If recommending a stock to friends, state up front, "I own this, and here's why." This honesty builds trust and sharpens your analysis. After all, when your reputation and money share the line, research deepens naturally. This personal accountability becomes your compass, steering through market noise toward choices that truly resonate with your values. Part 4. The Herd. Following and breaking away. Imagine standing at a busy street corner as dozens of people suddenly dash across against the light. Your instinct might scream, "Follow them." That same pull drives financial markets daily. This section explores why crowds sprint toward disastrous investments like lemmings off cliffs, and how resisting that current can protect and grow your wealth. You'll discover why smart money often moves opposite the frenzy, learn to spot dangerous groupthink, and build courage to act on your own research. Consider the dot-com bubble. In 1999, Lena watched friends earn fortunes overnight on tech stocks. Despite not understanding how these companies made money, she poured savings into flashy startups because everyone was doing it. When the crash came, she lost 70% of her investment. Lena's story isn't unique. Market history overflows with examples where collective excitement detached prices from reality, from Dutch tulip mania to the 2008 housing collapse. Why do we ignore warning signs when surrounded by cheering crowds? One powerful antidote comes from Ben, a retired teacher. During the 2008 panic, he noticed strong companies selling at fire sale prices, while others frantically dumped shares. Ben bought shares in a major appliance maker he knew had solid factories and loyal customers. Within 5 years, his investment tripled. His approach mirrors Warren Buffett's famous advice: be fearful when others are greedy, and greedy when others are fearful. What quality do you possess that the crowd might overlook? Resisting herd mentality starts with simple habits. First, track the Fear-Greed Index. Free tools like CNN's Market Mood gauge current market emotion. When extremes appear, pause. Second, write your investment thesis before buying. For example, I'm buying this renewable energy stock because its patents protect profits for 15 years, and demand will rise with climate policies. If news contradicts your logic later, you'll know when to exit. Third, limit exposure to financial media hype. Daily noise fuels impulsive decisions. Contrarian investing demands courage but offers rewards. During COVID's market crash, Priya invested in travel stocks when headlines predicted permanent industry collapse. She reasoned vaccines would eventually restore demand, and bankruptcies left survivors stronger. Her portfolio gained 120% in 2 years. Yet standing alone feels uncomfortable. Our brains register exclusion as physical pain. How might you prepare emotionally for that isolation? Practical steps fortify independent thinking. Allocate a small experiment fund, 5 to 10% of investments, for contrarian bets based solely on your analysis. Track its performance separately. This builds confidence without catastrophic risk. Also, join groups valuing debate, like investment clubs requiring opposing viewpoints for each trade. Finally, study history. Bubbles share patterns. Widespread belief, this time is different, ridicule of skeptics, and borrowing to chase gains. Recognizing these signs helps you step back when frenzy peaks. True conviction comes from work. Value investor Seth Klarman spends months scrutinizing company filings before investing, ignoring market chatter. His returns consistently beat the S&P 500. Like Priya and Ben, he proves that breaking away isn't rebellion. It's disciplined independence. Your money grows when you think like an owner, not a follower. What's one crowd-driven decision you'd reconsider today? Chapter 3. Building your safety net. Part 1. Diversify or die, spreading the risk. Imagine standing at the edge of a cliff with your life savings tied to a single rope. If that rope snaps, everything is gone. This section explores why spreading your investments isn't just smart, It's essential for survival. You'll discover how putting money into different baskets protects you when markets turn stormy. We'll break down common myths about diversification and show practical steps anyone can take. By the end, you'll see how this approach not only shields your money but actually helps it grow steadily over time. Consider Elena, who inherited $50,000 and invested entirely in a promising tech company. When that firm faced unexpected regulations, her portfolio dropped 60% overnight. Contrast this with Amir, who split the same amount among tech stocks, healthcare companies, government bonds, and real estate. During the same tech slump, his overall portfolio dipped just 10% because other holdings balanced the loss. This is diversification in action. It won't make you rich quickly, but it prevents financial disasters. A common misunderstanding is thinking more investments automatically means diversification. If you own 5 tech startups, you're still vulnerable when that sector struggles. True diversification means spreading money across unrelated areas, different industries, asset types, stocks, bonds, real estate, and even countries. Think of it like packing for unpredictable weather. Carrying both sunscreen and an umbrella means you're ready for anything. How many of your current investments rise and fall together? If they mostly move in sync, your safety net has holes. Building a diversified portfolio starts simply. For most people, low-cost index funds offer instant access to hundreds of stocks or bonds. For example, $10,000 in a total stock market fund spreads your money across thousands of companies. Add a bond fund for stability and an international fund for global exposure. Rebalance yearly. If stocks surge and become 80% of your portfolio, sell some to buy more bonds. This maintains your desired risk level. Remember Carlos? He chased hot stocks, ignoring diversification. After 3 years, his portfolio swung wildly between 40 and -30% annually. Maria used diversified funds instead. Her returns were steadier, +8, 10%, 7%. After a decade, Maria's consistent growth actually surpassed Carlos's boom-bust results. Steady wins the race. Diversification accepts a hard truth. Nobody predicts the future perfectly. Even safe companies can fail. Remember Blockbuster or Kodak? By spreading risk, you ensure no single surprise destroys your finances. This prepares us for the next step, identifying assets that weather storms even better. Our focus in the coming pages. Part 2. Safe havens. Where to hide in storms. Imagine a fierce storm hitting the ocean. While most ships toss violently, a few sheltered coves stay calm. Investments have similar shelters, assets that often hold steady or rise when markets crash. These safe havens can protect your wealth during economic hurricanes. This section shows you how to find these coves, use them wisely, and avoid common mistakes. You'll see why gold has been trusted for centuries, how government bonds act as financial shock absorbers, and where cash fits in. We'll also explore newer options and their risks. Most importantly, you'll learn to balance these shelters so they guard your money without sinking your growth. Storms strike markets regularly. In 2008, stocks crashed 50%, but gold rose 5%. During the 2020 pandemic panic, U.S. Treasury bonds surged while tech stocks plummeted. Safe havens work because people rush to them when fear spreads. Think of gold. It's physical, rare, and accepted worldwide. When paper money feels risky, gold often gains value. Government bonds, like U.S. Treasuries, are loans to stable countries. They promise fixed payments, making them reliable when companies might fail. Even cash, though it loses value to inflation, gives you options when prices drop sharply. Consider Leo, who kept 10% of his money in gold ETFs. When his stocks fell 30% in a market scare, his gold portion rose 8%, cutting his overall loss to 20%. Without that buffer, he'd have less money to buy cheap stocks during the recovery. But safe havens aren't magic. Gold can stagnate for years, like between 2013 and 2018 when it dropped 30%. Bonds can suffer if interest rates rise quickly. And cash? Park too much there, and inflation eats your savings slowly. How much of your portfolio could weather a 40% market drop without panic selling? Modern options exist, like certain currencies, Swiss franc, or defensive stocks, utilities, healthcare. During recessions, people still pay electricity bills or buy medicine, so these stocks often dip less. But beware, nothing is stormproof. Bitcoin plunged 65% in 2022's downturn, proving it's not a true safe haven. even traditional shelters have limits. In high inflation periods like the 1970s, both bonds and cash lost real value while gold soared. This is why experts like Benjamin Graham urged a margin of safety, never overloading on one asset. Priya learned this after keeping half her savings in long-term bonds. When rates rose, her bond value dropped 15% just as stocks rebounded. She missed gains and locked in losses. Now she uses a simple rule: only 5 to 15% in any single safe haven, spread across gold, short-term bonds, and cash. This mix preserved capital during last year's bank scares while letting her invest when others were fearful. What mix would let you sleep well during a crisis without sacrificing growth? Balance is key. Too little in safe havens leaves you exposed. Too much drags down returns over time. They're lifeboats, not the whole ship. In our next section, we'll explore how borrowing to invest can amplify gains or sink you faster in rough seas. Part 3. Leverage, the double-edged sword. Imagine borrowing a powerful tool that can build wealth faster or break everything you've saved. Leverage works exactly like that, using borrowed money to invest more than you have. It can turn small gains into big wins, but also turns small losses into disasters. This section shows how leverage acts as a double-edged sword, with real stories of people who soared or stumbled. You'll learn why our minds often trick us into overusing it and get clear rules for using it safely. By the end, you'll know exactly when this tool helps and when it harms, protecting the safety net you've built. Think of leverage as a magnifying glass. Sunlight through it can start a fire for warmth, but held too long, it burns your hand. Lena, a bakery owner, used a small loan to buy extra ovens before the holidays. Her sales doubled, easily repaying the debt, but her friend Omar borrowed heavily to buy delivery vans just before fuel prices spiked. His profits vanished under loan payments. Both used leverage. One succeeded because she timed it with predictable demand, while he ignored possible shocks. What unexpected event could shatter your leveraged bet? History shows this pattern repeats. A famous hedge fund once bet billions using borrowed money, convinced markets would stay calm. When Russia unexpectedly defaulted on debt in 1998, their losses multiplied. They lost $4 billion in weeks, nearly collapsing the global financial system. Their models ignored rare events, what Nassim Taleb calls black swans. Leverage amplifies the impact of these surprises. If your investment drops 10%, a 2-to-1 leverage ratio, half your money, half borrowed, turns it into a 20% loss. Could your portfolio survive a sudden 20% hit? Psychology makes leverage tempting. Winning streaks breed overconfidence, making us feel invincible. Dev, an experienced tech investor, started borrowing heavily after 3 successful years. He felt like a genius, forgetting luck's role. When regulators changed privacy rules, his stocks plunged 30%. With leverage, this became a 60% loss, wiping out years of gains. As Taleb notes in Fooled by Randomness, we confuse luck with skill. How might past successes blind you to hidden risks? Use leverage only when you have a margin of safety, a concept Benjamin Graham stressed. This means buying assets so cheap that even if things go wrong, you're protected. For example, only borrow to invest in stable assets trading far below their true value. Clara used leverage to buy government bonds yielding 5% when her loan cost 3%. She earned 2% extra safely, but she limited borrowing to 20% of her portfolio and avoided volatile stocks. What low-risk opportunity would justify borrowing for you? Practical rules prevent disaster. First, never borrow more than 25% of your total investments. Second, only use leverage for assets with steady cash flows, like rental properties or dividend stocks, not cryptocurrencies or meme stocks. Third, always simulate worst cases. If this asset drops 40%, can I cover the loan without selling? Finally, build an exit plan. Set automatic sell points to limit losses. John Bogle's advice applies. Leverage contradicts long-term discipline. Are you prepared to sell quickly if markets turn? Leverage belongs only in calm waters, not storms. After building a safety net with diversification and safe havens, adding leverage is like installing a turbocharger in your car. Useful on open roads, deadly on icy ones. In our next section, we'll study collapses like these to uncover deeper lessons from failure. Part 4, Lessons from Collapse, Learning from Mistakes. History's greatest investment disasters teach more than success stories ever could. When brilliant minds fail, despite Nobel Prizes and complex models, We uncover universal truths about risk. Consider how a single overlooked flaw can unravel fortunes overnight. This section explores famous collapses to reveal practical lessons you can apply immediately. You'll learn how to spot early warnings, avoid common traps, and turn setbacks into stepping stones. By understanding why others fell, you'll build stronger defenses for your own portfolio. In 1998, hedge fund long-term capital management imploded spectacularly. Its team included finance professors and Wall Street legends. They built mathematical models predicting bond price movements, assuming markets would always behave rationally. They borrowed heavily, amplifying bets with leverage. Then Russia unexpectedly defaulted on its debt. Markets panicked in ways their models never considered. Within weeks, LTCM lost $4.6 billion. Banks staged an emergency rescue to prevent global financial chaos. What caused this? 3 fatal flaws: believing past patterns guaranteed future results, ignoring extreme scenarios, and refusing to reduce leverage when risks mounted. Similar patterns emerge in modern failures. Take Arjun, an investor who poured savings into cryptocurrency startups in 2021. He dismissed diversification as for cautious people. When regulations tightened, 7 of his 10 holdings collapsed simultaneously. His mistake? Assuming one industry's growth made it immune to systemic shocks. How much of your portfolio depends on a single trend continuing unchanged? These stories highlight critical principles. First, maintain skepticism toward any sure thing. Benjamin Graham's margin of safety concept applies here. Always leave room for error in your calculations. Second, regularly stress test your strategy. Ask, what if my core assumption is wrong? Nassim Taleb demonstrated that rare events shape markets more than routine fluctuations. Third, heed warning signs. LTCM ignored rising market volatility for months before their collapse. When your investments behave unusually, pause and reassess. Rebuilding requires honest reflection. After Arjun's loss, he started journaling investment decisions. Each month, he reviewed 3 questions. What did I expect to happen? What actually occurred? Why were they different? This habit exposed his tendency to overlook regulatory risks. Within a year, his new diversified portfolio weathered 3 market dips without panic. What simple practice could help you spot your blind spots? Embrace mistakes as tuition for growth. Every failure contains data about market realities you can't learn from success. The key isn't avoiding errors, but ensuring no single error destroys your foundation. By studying collapses, you gain something priceless: the wisdom to protect what matters most while pursuing growth. Chapter 4. The Long Game. Part 1. Time as an Ally. The Magic of Compounding. Imagine planting a single seed in your garden. You water it consistently, year after year, never expecting a full-grown tree overnight. Yet decades later, that seedling becomes a mighty oak providing shade and shelter. This is compounding in action, your money growing upon itself, quietly building wealth while you live your life. In this section, you'll discover why starting early with even small amounts creates extraordinary results over time. We'll explore real stories and simple math showing how patience transforms modest efforts into financial security, and how avoiding get-rich-quick temptations leads to lasting prosperity. Consider Layla, who began investing $200 monthly at age 25. She chose a diversified portfolio, reinvesting all dividends. By 35, her $24,000 in contributions grew to $38,000, a modest gain. But by 55, without increasing contributions, her total reached $186,000. The secret? Her early starting money compounded longer. Contrast this with Ben, who waited until 35 to begin the same $200 monthly plan. At 55, he'd contributed the same $48,000 as Layla did by 35, but his portfolio totaled just $106,000. Layla's 10-year head start gave her 75% more wealth from identical effort. How might an extra decade of growth change your own goals? Compounding works like a snowball rolling downhill. Small returns generate earnings, which then generate their own earnings. For instance, a $10,000 investment growing at 7% annually becomes $19,600 in 10 years. But wait, it's not just about adding $9,600. Those new gains start working too. In year 11, the 7% return applies to $19,600, creating $1,372 in new growth versus just $700 in year 1. This accelerating effect explains why time matters more than timing. Reinvesting dividends turbocharges this process. Picture Nia, who owns shares in a stable company. Each quarter, she uses cash dividends to buy more shares. During a market dip, those dividends buy extra shares at lower prices. Decades later, her initial $500 monthly investment balloons beyond her projections because she consistently turned income into new growth fuel. What distractions might tempt you away from this steady approach? Chasing quick wins often sabotages compounding. Rohan poured savings into trendy stocks, scoring a 50% gain in 1 year. Flush with confidence, he ignored diversification. When those stocks crashed later, he sold in panic, locking in losses. Meanwhile, Elena ignored market noise, automatically investing in low-cost index funds monthly. Her boring strategy weathered storms because short-term drops mattered less than her 30-year timeline. Her final balance dwarfed Rohan's. The math is clear. At 7% annual growth, money doubles roughly every 10 years. Start with $10,000 at 25 and it becomes $80,000 by 65, eightfold growth. But achieving this demands discipline. Automate contributions to remove emotion. Review statements sparingly. Obsessing over daily fluctuations leads to impulsive decisions. Remember, compounding thrives on uninterrupted time, not brilliant timing. Are you allowing your investments the quiet years they need to flourish? This gentle power reshapes futures, but only for those who persist. Next, we'll see how pairing time with straightforward methods, like the index funds Elena used, creates unstoppable momentum. Part 2. Common sense wins, simple strategies. After witnessing how time magnifies even modest investments, we now explore the tools that best harness this power. Imagine building wealth not through frantic trading or chasing trends, but by applying clear, proven principles anyone can follow. This approach, rooted in discipline and simplicity, protects against costly errors while steadily growing your money. We'll see how ordinary investors achieve extraordinary results by avoiding complexity and embracing straightforward methods. Consider Leo, a graphic designer who once believed investing required constant attention. He spent hours analyzing stocks, paid high fees for actively managed funds, and panicked during market dips. After 2 years, his portfolio underperformed the broader market by 15%. Then he shifted course. He redirected his savings into low-cost index funds, baskets of stocks tracking entire markets like the S&P 500. Leo automated monthly contributions and ignored daily news. 5 years later, his investments grew reliably, matching market returns with minimal effort. His fees dropped by 80%, leaving more money to compound. What if simplifying your strategy could reclaim hours of stress and thousands in lost fees? Legendary investors have long championed this philosophy. John Bogle founded Vanguard on the premise that most professionals can't consistently beat the market after costs. Index funds solve this. They're inexpensive, diversified by design, and remove the guesswork. For example, an S&P 500 index fund holds slices of 500 large U.S. companies, instantly spreading risk. If one firm struggles, others offset it. This mirrors Burton Malkiel's insight that broad diversification is like wearing a bulletproof vest. It won't make you invincible, but it shields against devastating blows. Anya, a teacher, started early with this approach. She invested 10% of her salary monthly into 3 funds: a U.S. stock index, an international stock index, and a bond index. Her costs stayed below 0.1% annually. When markets dipped, she didn't sell. Her automatic buys purchased more shares at lower prices. Over 15 years, her portfolio weathered 3 recessions and grew 7-fold. Contrast this with her colleague Ben, who chased hot tech stocks. After initial wins, a single bad bet erased years of gains. Are you letting excitement override the steady path Anya followed? Practical steps make this work. First, choose low-cost index funds covering major markets. 1 for stocks, 1 for bonds. Allocate based on your timeline. Younger investors might hold 80% stocks, 20% bonds. Second, automate transfers on payday. Third, rebalance annually. If stocks surge and dominate your portfolio, sell a portion to buy bonds, restoring your original balance. This forces you to buy low and sell high mechanically. Fourth, limit portfolio checks to once a quarter. Emotional reactions to short-term swings cause more harm than market drops. Benjamin Graham's margin of safety principle applies here too. By keeping costs low and diversifying, you create a buffer against mistakes and volatility. Complexity invites errors, high fees, overtrading, or misjudging risks, while simplicity lets compounding work uninterrupted. As Nassim Taleb warns, unpredictable events will strike. A diversified, low-cost approach ensures no single shock derails you. Next, we'll address maintaining calm when markets turn stormy. But for now, ask yourself, could your investment strategy fit on a napkin? If not, it might be costing you more than you think. Part 3. Patience and perspective, riding the waves. Imagine watching your life savings shrink day after day. Your stomach churns. Every headline screams disaster. This is when true investors are made. This section reveals why patience and perspective transform market chaos into opportunity. You'll see how ordinary people weathered brutal downturns without selling and emerged wealthier. Their stories prove that emotional resilience, not market timing, builds lasting wealth. Learn practical ways to stay calm when others panic, avoid costly knee-jerk decisions, and keep your eyes fixed on the horizon. What separates those who thrive from those who barely survive? Let's find out. Markets rise and fall like ocean tides. Carlos, a teacher from Florida, learned this during the 2020 crash. His retirement fund dropped 30% in weeks. Panicked, he sold everything, locking in permanent losses. Months later, the market recovered. His sister Elena held identical investments. She ignored the noise, remembering her 20-year goal. Her portfolio not only rebounded but grew 15% by year's end. Carlos's mistake cost him years of savings. Why? He reacted to temporary waves instead of trusting the sea's natural rhythm. Volatility tests everyone. Our brains scream danger when prices fall, even if logic says otherwise. Nobel research shows losses hurt twice as much as gains please us. This instinct protected cavemen from lions but wrecks modern portfolios. Think of a roller coaster. Closing your eyes won't stop the ride, but knowing it ends safely keeps you seated. Markets have always recovered. Since 1950, the S&P 500 rose after every downturn, averaging 10% annual returns. Yet most investors earn less because they jump off mid-plunge. Build habits that override fear. Priya, an engineer, checks her portfolio just once a quarter. She writes her long-term goals on sticky notes. Retire at 60. Fund my kids' college. During the 2008 crisis, she reread them daily. This simple act stopped her from selling low. Another tactic: automate contributions. James, a baker, sets automatic monthly deposits. When markets dip, he buys more shares cheaply, without emotional debates. What reminder could anchor you during storms? History's greatest investors treat downturns as fire sales. Warren Buffett famously buys when blood fills the streets. In 1974, stocks plunged 48%. Buffett loaded up on undervalued companies like Geico. Those bets made billions over decades. Similarly, after the 2000 dot-com crash, disciplined investors scooped up Amazon at $6. Today, over $180. Panic sellers missed this. Temporary drops become permanent only if you flee. How might today's fear become tomorrow's regret? Prepare mentally before trouble hits. Review past recoveries. The 2008 mortgage crisis took 4 years to rebound, yet patient holders doubled their money by 2017. Also, diversify beyond stocks. Bonds, real estate, or cash reserves cushion falls. During the 2022 bear market, Lena's bond holdings rose as stocks fell, softening her overall loss. She slept better and held firm. Finally, limit news binges. Daily financial drama feeds anxiety. One study found investors who checked portfolios least earned higher returns. Could less screen time mean more wealth? True perspective means zooming out. A 20% crash feels catastrophic today, but over 30 years, it's a blip. Compounding works best when undisturbed. Pulling money out halts growth. Staying in lets time heal wounds. Consider this: $10,000 invested in 1980 grew to $700,000 by 2020, despite 10 recessions. Every recovery began when hope seemed lost. Your future self will thank you for waiting. Now, as we turn to personal investment paths, ask, what story do you want your investments to tell? Part 4. Writing your own story. Crafting a personal investment path. Your investment path is uniquely yours. It's not about copying others, but understanding your own goals, values, and circumstances. Think of it as drawing a map for a journey only you will take. What does success look like to you? Is it retiring early, funding your child's education, or building security? Write it down. Be specific. Having $500,000 by age 55 is clearer than being rich. This clarity becomes your compass. Consider your risk tolerance honestly. When markets drop 20%, will you panic sell or stay calm? Recall Aisha, who sold all her stocks during a 2020 dip, locking in losses. Months later, markets recovered, but her portfolio didn't. She learned her true risk tolerance was lower than she thought. Now she allocates more to bonds. How would you react in a crisis? Test yourself with hypothetical drops. If I lost $10,000 tomorrow, would I change my strategy? Build your strategy around 3 pillars: safety, simplicity, and flexibility. First, always leave room for error, the margin of safety. Don't bet everything on one stock. Diversify across assets and geographies. Second, embrace low-cost index funds. They automatically spread risk and outperform most experts over time. Third, review yearly. Life changes, marriage, kids, or career shifts, adjust accordingly. Raj started with aggressive tech stocks. After twins arrived, he shifted to balanced funds. His returns slowed slightly, but his sleep improved. Practical exercise: grab paper. Divide it into 2 columns. Left, my goals, e.g. buy home in 10 years, $300 down payment. Right, actions, e.g. save $500 monthly in low-fee growth fund. This links dreams to steps, updated annually. Finally, view investing as your life's subplot, not just wealth building. Every dollar invested is a seed for future choices. Freedom to travel, start a business, or help family. Omar retired at 60 not because he chased hot stocks, but because he consistently invested 20% of his teacher's salary into index funds for 35 years. His patience wrote a quiet triumph. What chapter will your investments add to your story? Start drafting it today.